Welcome back, innovators and investors, to Innovation and Income. I'm Manny, here to guide you through the complex yet rewarding world of finance. Today, we're unraveling the mysteries of the 401k plan and the magic of the employee match. Stick around, because this knowledge can seriously boost your retirement savings. Let's dive in. The information provided in this video is for educational and informational purposes only and does not constitute financial, investment, or legal advice. I'm not a licensed financial advisor or professional. Please consult with a qualified professional before making any investment or financial decisions. The content is based on personal opinions and experiences and should not be taken as factual or expert advice. First, a little history. The 401k plan traces its roots back to the Revenue Act of 1978. The Act introduced Section 401, which allowed employees to defer a portion of their income into a retirement savings account. The concept gained popularity in the 1980s as a cost-effective alternative to traditional pensions. The Tax Reform Act of 1986 further solidified its place in retirement planning. Over the years, the 401k plan has become the dominant retirement savings vehicle for many Americans. Employers and employees alike have embraced it for its tax advantages and the potential for growth through investments. The 401k plan has significantly changed how Americans save for retirement, shifting more responsibility onto employees to manage their retirement funds. It allows you to save and invest a portion of your paycheck before taxes are taken out, which means you're reducing your taxable income while saving for the future. The money that would have gone to taxes are instead placed into your account and further contribute to its growth. Over time, this can grow significantly through compound interest, helping you build a nest egg for retirement that stays with you and puts you in control. Compound interest is a powerful tool for growing your 401k savings over time. Here's how it works. When you contribute to your 401k, your money is invested in various assets like stocks, bonds, or mutual funds. These investments can earn returns, and the investments earned is reinvested, earning more interest. The key to compound interest is reinvesting the earnings. This means that you earn interest not only on your initial contribution, but also on the interest that has been earned in previous periods. The frequency of compounding can vary. It can be monthly, quarterly, or annually, depending on the type of investments in your 401k. More frequent compounding, ergo monthly, can lead to faster growth of your investments. Over time, the effect of compounding can significantly increase your retirement savings. The earlier you start contributing, the more time your money has to grow, and the more you can benefit from the compounding interest. For example, if you contribute $1,000 and earn 5% interest annually, you'll have $1,050 at the end of your first year. In the second year, you'll earn interest at $1,050, not just the original $1,000, leading to even more growth. The earlier you start contributing to your 401k, the more time your money has to grow, creating a snowball effect that can lead to substantial growth over time. The employee match is where things get really exciting. An employee match is when your employer contributes money to your 401k account based on the amount you contribute. Essentially, free money added to your retirement savings, contributing to your growth instantly. A typical math formula might be 50% of your contribution up to 6% of your salary. This means if you contribute 6% of your salary, your employer adds an additional 3%. To get the full match, you should aim to contribute at least the percentage of your salary that your employer matches. If you don't, you're leaving money on the table. Note that some employers have a vesting schedule, which means you need to stay with the company for a certain period of time before you fully own the employer's contributions. If you part with the company earlier than the vesting period, you will lose out on the employer match but retain your contributions and accrued interest. Once this time has passed, you are fully vested and have complete ownership of the match. There are also significant tax advantages. Contributions to a traditional 401k are made pre-tax, reducing your current taxable income. However, there are annual contribution limits set forth by the IRS. For 2024, the limit is $19,500, But if you're over the age of 50, you can make additional catch-up contributions. Contributions to a traditional 401k are made with pre-tax dollars, which reduces your taxable income for the year. For example, if you earn $75,000 and contribute $7,500 or 10%, your taxable income drops to $67,500. The money in your 401k grows tax deferred, meaning you do not pay taxes on the earnings as they accumulate. This allows your investment to grow more quickly over time. If you were to withdraw funds from your 401k before the age of 59 and one half, you may face a 10% early withdrawal penalty in addition to regular income taxes. Once you've reached the age of 59 and a half, you can start taking withdrawals from your 401k without facing the 10% early withdrawal penalty. However, you still need to pay income taxes on the amounts you withdraw. You can take distributions as needed, but it's important to plan carefully to avoid unnecessary taxes and ensure your savings will last you throughout your retirement. Many people are in a lower tax bracket during retirement, so they may pay less in taxes when they withdraw the money compared to when they were working. However, the tax codes can change every year and could have a positive or negative effect at the time you plan to withdraw. Starting at age 72, you must begin taking a required minimum distribution from your 401k. These distributions are subject to income tax. Now, we're going to do a bit of a demonstration. We're going to go into our calculator here. Now, if you go to calculator.net for all of your calculator needs, I like to utilize this site because it does have a lot of bespoke calculators, including this one that we'll be utilizing today, which is going to help us to calculate what our 401k would look like and how it would affect our overall retirement account based on our contributions. So let's start off with an age, something reasonable, let's say 30 years old. Hopefully you can start sooner than that. You may start later in your journey. This calculator is going to help you to determine what that impact would be. Let's go ahead and assume that we're starting off with a salary of $50,000 for the year. And we're going to start off with no balance for our 401k. We've made no contributions to this point, so we can truly see what impact this will have compounded. Now we have to make a determination what's going to be our starting percentage or our starting balance. Well, a lot of organizations, they will provide an employer match up to a certain percentage, and that's the percent that we want to at least start at, if not go higher than. So 6% is a good round number, where typically most organizations will have some form of a match up to that limit. So going in here, we can see now we have to determine what is the percentage of every dollar that we contribute that our employer will contribute as well. And in many cases, it's 50%. For you, it might be a 1-to-1 ratio. For every 1% you put in, you get 1% in return. And that would be tremendous. Any additional that the employer puts in would be excellent. So the employer match limit is going to be up to a total of 3%, because again, 6% at half would be 3%, meaning that you put in 6, your employer puts in 3% as a contribution. So based upon that, we see our retirement age. We're estimating 65. For some, it may be older. Some, it may be younger. We have a life expectancy here of 85. That can be adjusted. Obviously, nobody knows for sure how long we each of us have, but that is a good round average age of life expectancy today. Then we have our expected salary increases. This is making an estimate of 3%. Your mileage may vary. What this will do is estimate over the course of this age 30 to age 65, what will be your salary increases as you go through. And again, this is averaged over time. So there may be times where you may get more, and times where you get less. And if you change jobs, you can see a potential bump or boost in this. So again, these are estimates. Into the next, we have what is our expected annual return. 6% is a good rule of thumb. Some years it may track higher, some years it may track lower, but over the course of time, 6% is a safe estimate to put in here. That's why it's in here by default. Then we have our expected inflationary rate. Well, we don't go by any particular single year. This is averaged over time, and average is around 3%. Some years are going to be higher, some years are lower. And what this will do is give us a rough estimate and understanding of how far our dollars will go. That's our buying power. So based upon the information we've put in, we're going to go ahead and click calculate. And what it's going to do is give us an estimate on what that contribution looks like and what that amount results in. So we've gone ahead and we can see our graph on the left-hand side. We can see our employee contributions in blue here. This is every dollar that we contributed over the course of this 35-year span of time. And you can see that it overall accrues up, but you can see in the green, we also have what our employer match is. This is that little extra percentage that was on top that was a give me from our employer to be able to contribute to our 401k. And then in red, we can see that that is the one that has the most drastic difference. You can see curves straight up, more so than either of the other two colors. The other two are more gradual in their progression, where the investment returns are what we see that growth on. And again, that's the percentage growth as we start to see it build. So we have a breakdown here on the right-hand side. We have a total contribution. That's the amount of money that we put in as individual contributors. We have 226,733 over the course of this 35-year period. Of that, the employee, we as individuals, contributed 181,386, where the employer match is a $45,347 on top of that. Again, that's the cash on the table. We just need to make sure that we're picking up and not leaving behind. And then we have our overall investment return. That's 400,566. And we can see our total balance by the age of 65 is 627,299. This gives us an indication that based on the contribution, we're talking about a big bump in where we are, anywhere from like a 2 to 3x multiplier over time. The longer you have time to invest, the better off you are. And if you can adjust the percentages at all, let's see, even going up by 1%, going from 6 to 7%, we could see a jump again of nearly $100,000 in aggregate overall once we've reached the balance at age 65. This is just an indication of what this type of compounding interest can do. Your mileage may vary, obviously adjustments in picking the right stocks, and we know that portfolios in general average out over time. These are safe estimates and safe numbers. The more money you can earn, the more contribution, the more you can go ahead and put money into the 401k early and often. If we were to go ahead and let's go back to 6%, just to run it as a calculation and comparison again, $627,299 at the age of 65. If we were to turn around and instead of at the age of 30, we started making contributions at the age of 20 into our 401k, and let's calculate out what the extra 10 years do. The difference of 10 years, the difference of starting at the age of 20 versus starting at the age of 30, doubled our return by the age of 65. The sooner we start, the more consistent we are, it grows exponentially over time. Every year we can contribute. If we were to, we're at 1.285. If we were to delay retirement to the age 67, which as of 2024 is the current kind of vested retirement age for Social Security as an example, we'll see that it went up another $200,000 just by delaying 2 years. Every year, every month that goes by, that we're able to be in the market longer, we're able to contribute longer, we're able to let compounding interest do its work, is all time that's going to have a positive effect and positive result on the bottom line. Thanks for watching. Understanding and maximizing your 401k and employee match can make a big difference in your retirement savings. If you found this video helpful, hit the like button, share it with your colleagues, and subscribe to Innovation and Income for more financial wisdom. Remember, with the right knowledge, you can power up your financial future. Let's innovate, invest, and build our future together. Until next time, keep innovating.